Thanks so much for tuning in to BQ Conversations. We've been trying to get you a clutch of voices which are perched outside and looking at India, indeed at India for investing and looking at India's place relative to the rest of the world. And somebody perched in Singapore and currently in US, or should I say the other way around, perched in US generally, but currently all over, is Vikas Pershad. He's portfolio manager of M&G Investments and joins us right now on the show. Vikas, great having you. Thanks for taking the time out.
Wonderful to be here. There's a lot to talk about.
Yeah, and I understand it's good morning for you. So thanks for joining in so early in the morning. Just wondering, because the last 8 or 9 months, the chatter around India, both from corporate side who want to invest into India, work with India, and portfolio managers who want to put money into India has been fairly loud. From where you are sitting, how do you look at all of that, both from an somebody's observing it and somebody's investing actively into India?
It's a good question to start off the discussion with. What I would say is that I am in a fortunate position to have the choice among asset classes, among geographies, among sectors to invest in. I choose to focus on India for a reason. I choose to focus on Indian equities for a reason, because I think it is arguably the one market with the best long-term alpha generation opportunities in the world, certainly in Asia. There are others that are also good markets. The US is one, Japan is one. I think if you're very diligent as a stock picker, China can be one. There's some markets in Southeast Asia and Europe as well. India is the best. And fortunately, I've had this view for a while. Our team has had this view for a while, and it has been borne out in the numbers. Just for some perspective, you asked about the last 8 to 9 months. If we go back a little bit longer, if you look at the last 20 years, and MSCI India, MSCI Japan, MSCI Asia ex-Japan. So MSCI Japan has about doubled. MSCI Asia ex-Japan has a little bit more than doubled. MSCI India over that period is up 15x in local currency terms. If you look at it, if you adjust for the currency, which has halved, as we know, it's still up about 8 times in that period. Should that magnitude of outperformance continue over the next 20 years? Probably not. We're starting off a much higher base, but the absolute returns should continue. The relative outperformance, I believe, should continue. So again, there's a lot of data to support why there's excitement about India, but I still feel like despite all this, the India growth story is not fully appreciated, especially in the West. The India equity growth story is not fully appreciated, especially in the West. But this is, as investors are coming to that market, you are seeing why it's continuing to grind higher and higher and higher.
Got it. Just before I move full tilt to India, Vikas, just a word on how do you guys think about what the global macro would do to equities by and large? Because people, and you are in a great place to tell that to me, because friends who are visiting US currently are telling me that things are looking very, very strong, and the fears of full-blown recession are truly overdone or overplayed. How do you see that, thereby the Fed decision, thereby what happens to equities by and large?
Well, I'll say 2 things. Number one, we are in a position to invest in companies, not the market. So we pay attention to what is happening in the market. We are not ignorant of what is happening at a top-down macro level, but our investments are directly into companies. And we do a lot of homework in deciding which companies to invest in. We believe that as a result of our homework, if we place our bets correctly, we're picking the best management teams in the biggest white spaces. And irrespective of long-term macro conditions, they should outperform. They should be able to figure that out. So that is one way we hedge what is happening on a macro view. The other is time horizon arbitrage and focusing on the long term. And so that's the one thing I wanted to mention. The other thing is, if you look at the India equity story in particular, but emerging markets in general, they have become less sensitive to interest rate moves in the US, recession or inflation in the US. The markets that we are most excited about are very bottom-up, single country domestic growth stories. And I think in the future, you will see, yes, everything is related, but there's been an extent of decoupling that is helping investors in these individual markets as well.
Okay, so decoupling within markets and decoupling of specific high growth stories which may do well independent of what the macro situation largely might be. Okay, so here's my question.
Can I add one thing to that? I'd like to add one thing to that. If there's heightened geopolitical tension these days. You have it in Europe with the armed conflict there. You have it between the US and China and Greater China, what's happening there as well. If there is a company that is poised to benefit on multiple fronts, India is the one. If you look at how practical the government has been about where it's sourcing weapons, where it's sourcing oil, if you look at how practical companies have been in seizing opportunities from China plus one strategies, whether it is manufacturing and assembling of phones, whether it is specialty chemicals, whether it is healthcare delivery, or the domestic defense industry. We had a perfect example today with the IPO of the drone manufacturer. And I think India is in a very good position for all that to actually benefit from some of the tensions that are happening around the world.
Great. So tell me, Vikas, the common refrain that I hear from almost everybody who I talk to does speak about the confidence in the India story, but the starting valuations being a hindrance, even on pockets that they are bullish on, even if they are bottom-up investors. Now, my question to you is, are you in the same camp wherein you are looking at bottom-up ideas, but to put in large fresh money to work, starting valuations are a hindrance, or no?
I think India is attractively priced for investors. For a trader, it's a different situation. We are not traders, fortunately. And again, I reiterate that India is perhaps the best long-term equity market in the world. There's a difference between a valuation being pricey and a valuation being expensive. I view that India in pockets is pricey, but that's because that's where the growth is. That's where the cash flow generation is going to come. If you look at anything per capita, cement consumption, roads, automotives, housing finance, housing ownership, India stands out. Even if you take aside a large portion of the population that is not going to be in the consumption class anytime soon. People talk about the 1.4 billion, 1.5 billion. There's not a 1.5 billion consumers. The middle class is much smaller, but it is large enough to drive significant growth for decades to come. So that's one point, is that the Indian market is pricey, but not expensive. Also, people look at the headline multiples. You pick MSCI, India, Nifty, low 20s for 1 year forward earnings multiple. That is a snapshot. That's a picture. If you play the movie forward and you look at what that multiple becomes, within a couple of years, you're in mid to high teens. India is not a market that should trade in mid to high teens if everything else being equal, if other markets are where they are. So that is why that multiple stays high. This same argument has been made for decades, going back to the late 90s, coming early part of the 2000s, coming out of the dot-com bust, coming out of the GFC, coming out of COVID. And I come back to the point that India is pricey because that's where the growth is. So to answer your question another way, our cash levels in India are the lowest that they have been in the past couple of years. If we have gotten more capital, we have allocated more capital to India over the last 12 months amidst this rally, and we continue to feel like our portfolio is well positioned.
Yeah. Are you doing that now as well? And where are those pockets? Because I get this feeling that you are looking at very niche bottom-up ideas, independent of what the market valuations might be. So what is it that excites you about India in terms of the investing? What sectors, what themes, what kind of companies?
Well, coming into this year, there were some questions, given the outperformance of India and also Indonesia in 2022, could we expect continued absolute performance? And there was skepticism around the relative performance. Now, if you take out Japan, India has done very well in the Asian context. Southeast Asia has struggled. The absolute returns in India have been pretty good over the last year, going back to last summer, after the FIIs had done selling. If you look at the returns since late March this year, over the last 3.5 months, pretty much a straight line upward. And that is driven by earnings, that is driven by re-rating. It's also driven by people waking up to the India equity story. Now, where do I see opportunities in that context of a market that continues to move higher? It's across the board, really. We have been positioned well in autos and in healthcare, within healthcare, both pharma and in hospitals, in financial services, where we have been less heavily positioned. And I think this is pretty consensus now for the near term, is the IT services space. But if you hold that aside, I think there have been plenty of opportunities year to date, and there continue to be. We continue to like autos, four-wheelers and two-wheelers. We continue to like some of the industries related to autos, where it's tires, batteries. On the healthcare side, pharma, hospitals still look pretty attractively priced. One area where we have allocated more capital recently, and our team is doing more work, is on the defense side. If you just use a little bit of imagination and you read the paper every day, and you put together the short-term headlines and data points with the long-term opportunity, I think investors should be spending time on the listed defense space. Again, coming back to the IPO from today, that is a derivative of that. And I think there will be a lot of opportunities there as well. There are other industries like cement, like infracap equipment, that have very long tails to growth. historically, if you go back to 2004, 2009, 2014, 2019, there might have been concerns heading into an election year. Well, what will happen to these companies? But we're not far from the election, and many of these cement companies and infracap companies continue to hit uh, lifetime highs, and that is for good reason. I think the country is being built before our eyes, and for the long-term investor, there remain many opportunities across the board.
Yeah. So have these opportunities that you've picked up slices of been the recent companies? Because there's a clutch of new companies, if not new companies in the actual sense, but new companies in the listed space. Or are there opportunities which have been around for a really long time? Just trying to understand, are you grabbing the new age opportunities? Are you looking at something which is tried and tested for maybe a few cycles before?
I if you look back 2 years, I call them the class of 2021 IPOs. A lot of the tech companies that listed about 2 years ago in the second half of 2021. We are very lightly positioned there. There was a clutch of companies, to use your word, that came public. We own very few of them. And I think for some, it's a question about the business model in an environment that is more competitive and where capital is more competitive. In others, it's governance. Some of these companies are figuring out their governance still. I think some of them will get it, many won't. And then it's a question of valuation as well, in that context of governance still being determined, of business models in a more competitive environment. I know there had been a lot of excitement for them, and when they listed, many of them traded higher materially. But there are so many choices in India today. If you look at the listed space in India, on paper, there are 6,000 listed companies. There are about 1,000 that have a market cap of more than 150 million US dollars. Now, if you just for liquidity, for various reasons, very large promoter holdings, that universe of investable companies that are liquid probably is a few hundred, but you can craft a career around a few hundred companies. An individual retail investor can craft a very successful track record around those few hundred companies, where you do your homework, you bet right, and you sit tight and you hold for the long term.
Yeah. I heard you say that you like, for example, autos and ancillaries as well. A lot of these companies are now started doing different things. Two or three auto companies have a defense arm. Some of the auto companies are doing work for railways, which is also coming up like a big theme, and something like never before has been done out there. Is there an eclectic mix of consolidated operations that companies are giving, which excites you at all?
Interesting question. I haven't thought about it that way, but I think when I look at the sectors that you mentioned, ports, airports, rail, infrastructure, defense, I think in some cases these portions of businesses are still quite small. So this is why we do our homework. And in the very long term, they could be quite big. But some of the companies that you know that are based in Bombay and Pune, long-standing auto component manufacturing companies, they're exposed to the CV cycle, or they have large infracap equipment companies or businesses. The defense business or the rail business is quite small. But there are enough choices today that are available that are pure play companies on this theme.
Got it. Because one more thing that people tend to do quite a bit, and a lot of papers written there is about how within the India context or India versus the EM context, the per capita moving up has a disproportionate impact on what discretionary consumption does over a period of time, over the few years, when per capita moves from northwards of 2000 to whatever, 3.5, 4, etc. People give me examples of Korea, China, some other countries. Do you guys look at it that way at all?
On the discretionary spending side, we
Yes.
do. It's one of the inputs that we look at, and it helps us frame and reframe in times of market dislocations what the long-term opportunity is. But it's interesting that you ask about the discretionary space. I would say if you look at the portfolio today, we can't own everything. If we were, we would just own the benchmark. We are less heavily positioned in IT services, as I mentioned, in some of the discretionary names, as I mentioned, and then in the class of 2021 tech IPOs. That is not a function of growth not being in the discretionary space, but it's our view that there are better opportunities elsewhere. If you combine valuation, top line growth, margins, some of these discretionary areas, I think, might have peaked in terms of the multiple that they will get and the margins that they can reach because there's so much competition. If you look at the air conditioner space, for example, if you look at the cooler space, for example, these have become very competitive. And the top line growth story is very seductive. The margin story, not so much. And rather than the OEMs, I think on the assembly side, there are companies that are doing the assembly of these products. That might be an area where there's still a longer tail to growth, and also an opportunity for stable or expanding margins. So that's where we have shifted our attention.
Got it. Last couple of questions. One is on real estate, and also because not just, I mean, it's a big boost to the economy, but real estate plus ancillaries becomes a very wide bucket because people talk about we being in the midst of an upcycle in India, relative, I mean, contrary to what the rest of the world might be going to. What are your thoughts here? Are you constructive on the mainstream real estate companies or the ancillaries, as the case may be?
Well, let's broaden it out for a moment. If you look at our portfolio, housing broadly defined, so this includes housing finance, property, the companies that are providing paints and pipes and adhesives. If you include all that, that is the largest bet in our portfolio. Housing broadly defined. And you have elements of increasing access for the consumer, rising incomes, greater expenditure, per capita consumption, per capita penetration of various industries. So yes, we remain very constructive on that. And again, if you broaden it out, there's a lot of companies in India that are benefiting from that theme.
You bet they are. Because my final question, I heard you mention that you believe that from all the things that you're seeing, you're choosing to be a portfolio manager in India, and you believe India is the best. What's the risk to this very positive sounding story about India currently?
I ask myself this daily because I ask it more often now because it seems like if you look at the fact pattern, the story lines up so well, then you have to ask yourself what could go wrong, what might derail it. However, what I try to caution myself from is becoming too cautious, too pessimistic. I think India is the perfect market where you could be optimistic for the long term. I think it's very difficult to make money in the long term by being pessimistic, by being negative. But that doesn't mean that we shouldn't be ignoring risks. So what could happen? Before I answer that, I'll put forward some numbers, right? So today, GDP in India, somewhere between $3.5 to $4 trillion. Given the rate that it's growing, and even within a reasonable range that might be below that, in your lifetime, my lifetime, and the lifetimes and careers of your viewers today, the GDP is likely to go up at least 4x. It's going to double and double again over the next perhaps 20 years, 25 years. That is an incremental $12 trillion of GDP that is going to be added. Now, even if it's not 12, let's say it's 10 or 9, that is a massive amount of opportunity for companies. That is a massive amount of opportunity for investors. I think it's pretty difficult to derail that story. In Q1 this year, we were asked, given the outperformance last year, given some of the excitement around certain business houses and reports that came out, is the India growth story derailed? One company is not going to do that. One short seller report is not going to do that. One policy change is not going to do that. Just before I joined, I saw some headlines that perhaps we might have some changes in the finance ministry soon, right? And one change is not going to do that. So I think it has to be some sort of external macro shock, but I think the ball is now rolling. The momentum is there. And this is not something that just started 2, 3, 4 years ago. This started in the early 90s when the economy opened up. And this is going to continue for a long time. I think the risk for investors is that they sell too soon, that they become too cautious, and that they don't do their homework. Again, coming back to this point about thousands of companies and almost every major sector represented, there's a risk that people are too diversified and not doing their homework and not in the right companies, and they sell too early. I think India is a perfect example of the power of compounding and the power of doing your homework. And I remain very excited. Our team remains very excited about the opportunity to participate in the India growth story for decades to come.
This is music to the ears of anybody who's listening to this, Vikas. And जैसे कहते हैं तुम्हारे मुंह में घी शक्कर. So yeah, let's hope that happens. But thanks so much, Vikas. Really appreciate your time. And in a lovely setting, I might add. Thank you for joining us all the way from the US. And look forward to talk to you more often, Vikas.
I'll be there soon. We should talk in person. There's a lot to talk about.
Looking forward to doing that. But thanks for taking the time out today.
My pleasure. Thank you, Neeraj.
And viewers, thanks for tuning in.
How do you make the most of the India opportunity as an investor? For that answer, all roads lead to BKC in Mumbai on the 13th of July. 3 big money managers describe the size of this opportunity. 2 of the largest mutual fund CIOs then tell you about the mega trends that they're investing in. Will the current capex cycle be similar to the one between 2003 and 2008? We get that answer from Sanjeev Sharma of ABB in a conversation with veteran investor Madhusudan Kela. And then we rounded off with 2 of the most prominent investing names talking about how to make the large bets and make it really big. All of this and more at the Trident Hotel in BKC on the 13th of July. Catch the action live on BQ Prime and NDTV.